Right. Good morning, everybody, and welcome to this Airmic Fast Track webinar, Captives as part of a long-term plans for risk financing. My name is Alexander Frost. I'm the Chief Markets Officer at Airmic. It's my pleasure to be the Airmic host for this morning's session. Just a quick word on housekeeping. This session is being hosted, as are all webinars for the last year or more, on our Livestorm platform. I assume that many of you on the call, or most of you, are familiar with it, but just in case you are not, two things to point out. To the bottom right of your screen, you will see a questions tab and a chat tab. The chat allows you to send messages between attendees, so internal chat for yourselves, and the questions tab allows you to send questions for our speaker to answer at the end during the Q&A. Also, towards the end of the session, when we are having the Q&A, a survey will pop up so that you can give some feedback to us on the content and your satisfaction with the platform, and so on. So look out for that towards the end. So, as I say, today's session, Captives as part of plans for a long-term plan for risk financing. This session is an opportunity to learn about the basics of captive insurance and understand why more and more large and medium-sized companies are using captives as part of their long-term risk financing strategy. This is a particularly important subject for us at Airmic, not least because, as we've been discussing a lot in recent days, changing market conditions, questions around adequacy of capital and around the ability of traditional lines of coverage to provide the coverage that you require mean that there is increasing interest in captives amongst the membership. One of the reasons that we now have an annual captives forum in March every year. And we are delighted today to have Justin Upson, Director of SRS Corporate Services, which is the fiduciary license vehicle of SRS, with us to speak on this subject. Now, Mr. Upson has a wealth of experience managing Guernsey-based licensed insurance entities, providing innovative solutions to his clients with specific experience in the management and oversight of captive and commercial insurance companies. He served as a board member and acted as client lead on a diverse range of captive insurance and commercial and general reinsurance companies through various structures such as protected cell companies, PCCs, and standalone vehicles. Overall, Justin has 35 years experience in the Guernsey finance sector. So as I say, we're very fortunate. Justin, thank you very much for being with us this morning. And thank you to our good partners at SRS for supporting this webinar. And very, very happy to hand over to you. Just before I do so, I beg your pardon, the learning objectives. By the end of this session, you'll be able to define what a captive entity is, identify the different types of captive, including cellular and non-cellular structures, state why and when a captive can be used, assess the potential value of setting up a captive solution, and explain the processes involved in implementing a captive program. Justin, thank you very much, and over to you.
Thank you, Alex. Welcome, everybody. So just to start with, what is a captive vehicle? So a captive vehicle is a formal mechanism to finance and self-insure risk by way of insurance, and forms part of a client's total cost of risk analysis in optimizing its insurance program by means of a captive insurance vehicle, as well as using the external market for the placement of a parent's risks. They're fully licensed and regulated entities, generally, but not always, located in a domicile where specific captive insurance legislation exists. The parent utilizes the captive vehicle, but the day-to-day operations are typically outsourced to a professional insurance manager, such as SRS. The term captive includes wholly owned captives, regulated subsidiary, but also protected cell captives owned and rented as part of a wider vehicle. What are the risk finance structures options? So there's various options in which you could, a parent company could look at self-insurance its risks. So you've got on the left-hand side here, you've got operating cash flow, pay as you go. On that basis, you have retained losses that are paid by the business units as and when they occur. Alternatively, a parent might utilize a central fund, which is described as a virtual captive. Essentially, that's just a bank account where a pot of cash is allocated to which it will pay a specific type of losses. Going over to the right hand of the sides, you then look at the captive vehicle options, and there's various options that you can have. You can have a protected sale within a protected sale company, which is described as a renter captive. You could have your wholly owned PCC. So we'll come on to PCCs a little bit later in the slides, or you could have a wholly owned captive, which can be utilized for the insurance program. Why and when to use a captive? So we've got various triggers here, but starting with the financial side, as I touched on earlier, it's a mechanism to optimize the total cost of risk by capturing underwriting profit, reduce external premium spend, and provide protection to business units from losses and the volatility around that. From a strategic perspective, you've got greater control and flexibility. It acts as a shock absorber in terms of the insurance market and the volatility that you can see in premiums rates going up and down throughout cycles, planning for future growth and changes, and fund the higher deductibles that are enforced by general and market insurers. From an operational side, and usually this is a key factor in setting up a captive, is that if an organization has a really good risk management framework where it's got good systems and processes in place, which ultimately lead to lower level of claims, to which you're paying a significant amount of premium to the market, but not really capturing a great deal of profit from it, because that's just all externalized. This is where, from an operational side, it's critical, because you have increased control and control over claims and management. You're building up that statistical analysis of claims internally. You can establish accounting for reserves for undeveloped claims and claims deterioration, data control and management, capturing of that, and key thing which is an advantage to a captive is it allows you access to the reinsurance market. So if you weren't looking to potentially retain all losses within the captive, you have the option to reinsure out to the reinsurance market. Financial drivers. Kind of touched on this in the earlier slide, but in the insurance market, generally that suits pure risk transfer, where you've got potential high losses or the fear of high losses, to which you just place the entire risk with the market for a level of premium. You then have formal risk retention, which may suit centralized risk funding, the use of captive, and that's where you get the value of a captive. Essentially would cover like your attritional losses, and then you get the benefit of the market coverage for the higher levels of the program. And then you have the business kind of dealt with by budgets within like the business units themselves. So generally, the financial cost, if external premium savings exceed increased retained lossing, that equals lower cost of risk. Whereas if you've got premium savings, retained claims, your total cost of risk reduces. Just looking at the captive drivers, So just going down, you've got reduced insurance cost by the use of captive. Generally, the general insurance market will give a discount to the premium on the basis that they are being moved away from where the traditional claims are occurring, so what we describe as attritional losses. You have increased and improved cash flow over reserving for unpaid claims on owned premiums. Um, Investment income. Typically, if a captive is writing longer term risk, you have the benefit that you can place those premiums on long term investment strategies which yield investment returns. Predominantly, I mean, in the current environment, the kind of rates of interest as they stand at the moment would typically cover the costs of running the captive. You've got the matching revenue and expenses, um, and then typically a captive, we describe it as an incubator for risks. So sometimes there may not be the breadth of coverage available in the market, or it's just not economical to place it with the market. So the captive can act as an incubator of risk, which allows statistical information to be built up over a couple of years, which the parent company could then, in theory, take to the market with some real stats in terms of how the risk is performed, and then maybe the market would participate at a later date. Clearly, as we've described here, the use of a captive is reduced reliance on the commercial insurance market and improved risk management processes. So what to look for? Positive indicators, sustained low loss ratios. Client has confidence in its own strong risk management practices. Client desire to consider alternatives in terms of just placement with the pure insurance market. Client is willing and in a position to take on additional risk on its balance sheet, and ultimately looking for innovation to create market differentiation with the use of a captive. Negative indicators, premium rates increasing, higher deductible levels being forced by the market, policy limits, capacity reducing, policy coverage limitations and exclusions, and emerging risks, as we've touched on, in terms of difficult to insure economically certain types of risks. In terms of the kind of critical mass factors for the decision to place a risk with a captive, there's usually a minimum amount of premium and retention and loss ratio that you'd be looking for in terms of your viability of the use of a captive analysis. So generally, anything below 500,000 is unlikely to be viable to produce a captive vehicle, because the running costs, etc., just would not be commercially sustained in terms of that kind of level of premium, which is the income to the captive vehicle. Greater than 500,000, then you're looking at potential territory of forming a cell within a protected cell company. And that's kind of ranging from 500,000 up to 1.5 million, which be looking at a million aggregate. Then you go on to a single parent captive, which generally looks at a premium spend of greater than 1.5 million and retentions of 2.5 million, etc. In all cases, having a stable loss ratio of around 70% is key in terms of placing that risk, in terms of like ensuring that the captive can build upon its retained earnings and becomes sustainable for future use and future consideration of lines. We've touched on employee benefits and critical mass here. This is something that during my previous career, I did have a client that was very keen to place their employee benefits program. We managed to do that very successfully across 27 countries. It proved to be very profitable, but generally, that type of risk you do need to outsource some of the management, particularly if it includes medical expenses cover. And reinsurance is quite critical in that respective. So some of the big players would probably look at a minimum of 5 million employee benefits program before they'd be interested in participating as part of that risk. Just looking at the minimum capital requirements. So here in Guernsey, the minimum capital floor for setting up a captive vehicle is 100,000. Now, the way things are modelled is that you have to consider the solvency implications of the captive vehicle. So the 100,000 is the capital floor, but the actual capital requirement will be based on the type of risk you're writing and the level of capital requirement to actually write that risk. That compares to the EU, where the kind of minimum capital requirements range from 1.3 million, and then certainly on onshore direct writing captives, 2.7 million stroke 4 million. Looking at the operational costs, typically if you were to set up a cell, there'd be a one-off fee of 15 to 20,000. That would usually involve support by the appointed manager that would be running the vehicle, but also include regulatory fees in terms of a one-off fee to get it licensed. And then the annual kind of cost of managing that ranges from 50 to 60,000. Compared to a captive, obviously this is a full-blown standalone vehicle, so the costs tend to be slightly higher and typically range from 20 to 30,000 setup fee, and then 75,000 to 125,000 annual fee. And I have seen certain captives that are much bigger vehicle doing multiple lines where the fee can range right up to kind of 200,000. And it's really dependent on the workload that's involved in managing that vehicle. So we'll touch on cell structures now. So this is kind of what I would describe as if a company is looking to self-insure some of its risk, this is a good opportunity to put a toe in the water in terms of utilizing a self-insured retention vehicle. So typically, a protected cell company is a single legal entity, typically established by a third-party sponsor who maintains the minimum regulatory capital, which in this case is the actual core company. If a company you wish to utilize a protected cell, generally what they have is they have a cellular setup where they become the cell shareholder and fund the risks to be insured into the cell, and all those assets and liability are essentially ring fenced within the protected cell company structure. So one risk written by one cell cannot contaminate the risk written by a different cell. And then the PCC generally looks after all the regulatory reporting and audit. And then, as mentioned, each cell's assets and liabilities are ring fenced. Guernsey was probably the domicile which was the grandfather of the legislation. So the legislation started in Guernsey and has quickly expanded to other territories. Not all territories currently support it. So Dublin, Switzerland, Luxembourg have not enacted the legislation. But who knows, they might do in the future. Features of a protected sale company versus wholly owned captives. Wholly owned captives tend to look at their total kind of risk that they want to place, can purchase reinsurance across both vehicles. The regulation is exactly the same for a protected sale versus a standalone vehicle. The management, again, for the outsourcing is generally outsourced to a professional insurance manager. The ownership, broadly, the way this differentiates is the ownership of a standalone captive is the insured parent group, whereas the ownership of the cell is definitely the parent company, but the ownership of the actual core company, which technically has the license to underwrite, would be owned by either the group, or if a company chose to insure using a third-party owned PCC. So in Guernsey, a lot of the managers have their own PCC as part of their corporate structuring, which allows clients to access a protected sale kind of solution. Under a standalone captive, the captive board and domicile controls all the day-to-day governance and will have generally a non-exec director, and sometimes the client might choose to have a representative of the manager, and then typically there'll always be a nominee from the parent company itself that will sit on the captive board. Compared to a cell structure, the parent company doesn't tend to sit on, certainly if it was like an SRS managed and owned vehicle, the control is the parent company's of the manager. Ordinary voting shares in terms of capitalization, and then for cellular structure, non-voting redeemable preference shares. So the kind of key cell advantages and disadvantages. Cell advantages are lower cost of entry into the market, lower operational cost of setup, faster setup. So in Guernsey, probably around 2020, the Guernsey Financial Services Commission introduced the fast track process for protected sale companies, which allow companies to essentially set up a cell within 48 hours, providing it's deemed as a captive vehicle. And then generally you'd follow through within, say, 2 weeks to file all the appropriate documentation that needs to be required. This was particularly a good solution around 2019-20, when PI market was becoming challenging, and a lot of clients wanted to set up a vehicle to cover their own risks in that regard, and we were able to do that within 48 hours, which provided a quick solution. In terms of cell disadvantages, as kind of touched upon, there's less perceived control, because generally it's the board of the core that kind of sits above the core, but also the protected cell vehicles. It's not available in all domiciles, and potentially higher, less flexible capital funding requirements. So a lot of the times you might require a fully funded program, for example, whereas a wholly owned captive vehicle, there might be scope to basically have a bit of a risk gap that is manageable, deemed manageable, with obviously contingent resources available from the captive in the event that they had kind of full aggregate losses. Just touching upon now the captive evaluation to implementation. So generally how this works is like it'll start off with a high review of the program, an assessment of claims versus premium spend. Then it will be a case of looking to see whether or not it is worthwhile going into a detailed captive feasibility study. The captive feasibility study, if launched, then looks at the various areas, starting with the evaluation of risk tolerance, captive drivers, an appetite for retention of risks, evaluation of captive domiciles and structures, detailed analytical and probabilistic risk modeling, and captive cost benefit analysis, including capital and costs. If all that following that feasibility is a kind of green light to go to full implementation, then internal business plan will be approved, and then the preparation of the captive business plan and submission to the regulator is then performed. And then once approval is received from the regulator, the vehicle is then licensed to go into full active underwriting. I see there's a couple of questions that have come up. Just look at these very quickly. Yeah, we'll come on to that a little bit later under the question and answers. Thanks. Yeah, just looking at the captive feasibility study in a bit more detail. So it kind of goes through a process of define the risk financing priorities and goals. That will have various leadership discussions. The risk managers will be working very closely with the CFO, finance directors, in terms of looking at the costs of the program and optimizing that total cost of risk assessment. Evaluation of optimal vehicle structure and domicile are all key considerations. Then you've got the retention optimization, so assessing where you believe your claims will actually sit versus the amount above that you're willing to also take on, which allows for the general insurance market to discount their overall premium for the total cover requirements that the parent company needs. Then you go into the captive cost benefit and analysis, and that will involve looking at the thresholds of the kind of retentions to be maintained, and then looking at all the solvency and capital requirements, modeling and operating costs that are involved in that process. And then upon conclusion, it's a summary of all findings. If everything, looks very positive, then it will then go to formal process of implementation of the actual plan and formalization of the regulatory approvals. So SRS, how can we help? So SRS is an American company which has been established since approximately 1993. SRS expanded into Europe in 2017, establishing its European headquarters in Ireland. In approximately, I think it was 2021, we established an office in Guernsey. And we also have offices in Europe, based in Ireland, Luxembourg, Netherlands, Sweden, and Switzerland. Our core services are essentially cover everything. So independent insurance company management. We provide actuarial services, governance, compliance, risk finance consulting, and innovators of new products and technology. Here's a question from Scott. What timeframes could it take from the start of captive feasibility study to full implementation? So generally, Scott, I think looking at programs, if a company was looking to potentially renew with a captive solution, I would say the process would need to be at least 6 months before that renewal. Generally, once the feasibility, and these can be presented pretty quickly and performed pretty quickly, and it's, I mean, the key thing there is making sure that we've got the availability of data, and generally what we'd be looking for is at least a 5-year claims history and premium spend history, which would allow that analysis to take place. Once we've got past the kind of approval process in terms of the feasibility study, then it would be a question of getting the regulatory business plan into the regulator and getting approval. And they generally in Guernsey take approximately 8 weeks, 8 to 12 weeks. So in theory, you could decide that you wanted to use a vehicle, and the process would probably be about 6 months, including the feasibility process. I hope that helps. So as mentioned, our core services: consulting, managing captives, insurance companies, actuarial services, governance and compliance services, and we are looking at new products and technology which could be outsourced as part of the day-to-day management. How do we do it? So we are the largest independent captive management group, so we are not broker owned. We have multiple domiciles in which we can manage captives, high quality service and flexibility to your needs. So just going on, we've got a case study roadmap for an alternative solution. So the background to this was the Prospect's existing program was that they had 40 million aggregate limits, and there is no anyone loss cover available. The anyone loss cover was 100,000 deductible, and where increases were being incrementally imposed by the insurers over the past 5 years. This particular vehicle had a primary layer 5 million, excess 900,000, and 10-year annual average claims was 100,000. So the market factors that affected this particular client in this scenario was the market was moving away from providing the anyone loss cover for mid-sized firms, forcing the client to purchase higher limits to meet stakeholders and own requirements. Thus, the premium spend was essentially going up with less cover for claims at the lower attritional level. The solution, which is a comparison here, is that had the client gone with the external market, the premium spend would have been 1.8 million. But with the retention of 900,000 excess of 100,000, that total cost of risk, the premium spent was 900,000 to the external market, and the claims retained, which were retained in any event, were 100,000. They had a retention cost of 185,000, which is basically deductible losses, etc. Fronting fees and running costs of the sale. So the net saving in that regard was 620,000 by utilising a self-insured retention using a captive vehicle. The key thing to obviously always remember is, captives generally and statistically speaking will have average claims, but there's always the risk that you do get that large claim. So it must be remembered that the capital at risk in this scenario was 5 million. But the company was able to get a capital return on that investment of 12%. I think we're slightly ahead of schedule here. So I think I'm going to hand you back to Alex now, and then we can spend a bit of time on the question and answer session.
Yeah, absolutely. Thank you, Justin. And thank you very much for that very comprehensive overview. So just one more time to take you through the learning objectives. There, you can see them on the screen. I won't read them out again, because I'm sure you'd much rather hear from Justin than hear from me. And we have some questions that have come in the questions tab. I don't know if you've seen these yet, obviously, but just looking down them, you saw the one about the PCC, Justin,
Yes,
from
I did.
Lot.
Yeah.
Did you see Grace's above it?
No.
So for an organization with minimal claims history, low deductibles, and annual premiums exceeding 5 million, how viable is a captive insurance structure as a risk financing strategy? And what key considerations would determine whether forming a captive is appropriate in this scenario?
I think if you've got an external market spend of that kind of level and you have got a great claims history, then it's definitely a consideration to form your own captive vehicle. The idea is that you're going to get the benefit of all those profits that would otherwise be spent with the insurance market, which aren't recoverable. By setting up your own vehicle, you're going to benefit from having those retained premiums within your consolidated group. So most definitely, a captive solution would be a viable option in terms of that. I mean, the captives generally do look at and operate at the attritional loss level, so kind of around the deductible. I have seen programs where a captive will operate around that level, then may place part of the risk to the external market, and then may come back in at a kind of excessive loss level. So there's different ways of actually structuring a captive program, but traditionally it's operating at that kind of attritional loss level.
Right. Perfect. We have a question from Ruth about captives in public sector bodies. So how do captives sit, or do they sit with public sector bodies, and are they used extensively?
Yes. In
a word.
Yes, I won't divulge names, but I used to manage a captive which was owned by a public sector body. So they are utilised and sit well within that framework.
And are they often used as a primary source of risk financing for those organizations? I mean, I know a couple as well who are AIRMIC members who use it, but I'm not sure to what extent.
Yes, most definitely. Again, when you're looking at the cat risk side, they tend to place that off. But I'd say, like the vehicle I was involved with, it was actually the primary insurance carrier, and then it had cat risk in terms of terrorism cover, etc., that it placed out to the market. So yes,
Brilliant.
I have seen those vehicles.
Okay. So next question from Scott. What are the advantages of Bermuda versus Malta versus Guernsey apart from the weather? Uh, now I know
Yep.
in Malta, obviously there's a PCC issue or an
Yes.
advantage, but perhaps you could tell us a little bit more about those different jurisdictions.
Yeah. So yeah, I think it's well. There's difference in the kind of flexibility. So I'd say in Bermuda there's a higher capital requirements. Certainly in Malta as well. Um, in Guernsey, we tend to have we kind of when the whole kind of Solvency II framework came out, Guernsey opted for a kind of Solvency One light version, or Solvency II light version, shall I say, on the basis that they kind of considered that the whole Solvency II framework wasn't really fit for purpose in terms of like captive vehicles. So the regulator, in terms of the industry bodies here in Guernsey, opted for a more bespoke, fit for purpose approach to solvency requirements. So that's one of the advantages. The costs and the travel is obviously another consideration. Location, how easy it is to kind of access the territory, um, etc. That's something that needs to be considered. But it depends what type of risk you're looking for as well. So Bermuda obviously has quite an extensive reinsurance market, which might be more attractive for the placements,
Yeah.
etc. Hopefully that answers
Mm.
the question. Yeah.
I'm always trying to convince the leadership here at Airmic that we
Yes.
should invest lots more time, energy, and
Yeah.
activity in Bermuda, so that we can get ourselves over there more. But an
Yeah.
interesting question here, Justin, which if I may just jump in with one
Yep.
before we carry on. But obviously, there's been a lot of talk in recent years about some of the big European economies becoming captives domicile. I mean, France, for instance,
Yeah.
has now opened itself up, and of course, there's a consultation going on right now in the UK about whether we should be able to domicile captives here. And I presume that's because of the existing insurance market infrastructure and the
Yeah.
ecosystem that already exists in London. So,
Yeah.
would you agree that's what's behind it?
I think so. Yeah. And we've obviously been monitoring that very closely. Um, but yeah, I mean, there is an established market. We're keen to have attractive other solutions. Um, you know, particularly in Guernsey, the captive market has been established since the early 70s. So you've got very experienced professionals, and we work closely with London,
Yeah.
etc., and other territories. So I think it's all positive because it just creates other solutions for potential captive owners.
Yes. Yeah. Absolutely. So another question from Brenda: how does SRS work together with, for example, brokers on different insurance lines?
We work with all brokers. Yep, it's just part and parcel of the work we carry out. So we tend on captive programs to work with a multitude of different brokers, working closely with them in conjunction with the risk manager, of course, in terms of the placement. But yeah, we will have direct dialogue as required in terms of managing that process.
And okay. A question on financial disclosure then. What extent of financial disclosure is required in company accounts when setting up a captive? Does this differ from if it's a sell or a full structured captive?
Yeah, so if it's a standalone, you're obligated to produce your annual audited accounts, and the level of disclosure will be very much dependent on whether or not you've opted for IFRS accounting or FRS 102 with a derogation from 103 is possible for captives. Um, a protector sale company in converse is usually it's the protector sale. The way the accounts are structured is you have the numbers of the call, which are shown separately. But if you had multiple sales, then they are disclosed as just cellular performance in terms of underwriting, profit and loss, assets and liabilities. So they're just bulked together. So they're not isolated in terms of sale one, sale two, sale three. Guernsey in particular, it's not similar in terms of disclosure like you'd have in the UK Companies House. So we have the Guernsey registry where we don't submit financial statements, so they're not publicly available. The only submission that we have to do of our accounts is to the Guernsey regulator.
Brilliant. Question from Lot. What evolution do you see in the use of PCCs? Is there any trends that you can highlight in that respect?
I mean, PCCs are still very much used. As I mentioned, we've seen various trends. So when I joined SRS back in 2020, joined Robus following being acquired last year by SRS. So joined Robus in 2020. One of the things that was really pushing parents is that PI market hardening. Lack of capacity and increase in premium rent. So that was really a solution that was well welcomed. And the fact that we had the fast track process to get underwriting within 48 hours was an absolute fantastic achievement. But we see various things that come through. So we've seen, I guess, yeah, I mean, looking at a solution to try and test out the water is a common trend that we see, and it really depends on the kind of program being written as well. If a company decides to set up its own protected sale company, then it can have a risk appetite to have a risk gap. If it was using a manager-owned vehicle, then a risk gap is possible, but there needs to be contingent funding. So essentially, certainly in its formation years, we tend to insist that the risk gap is fully funded.
Brilliant. And then our final question, how does a soft traditional insurance market affect the relevance and attractiveness of using a captive? It's a very good question.
It is a very good question. And I think the answer is, given market cycles, they don't always remain soft. So, I mean, the use of a captive is very much trying to smooth the kind of peaks and troughs of volatility of the market over a long period of time. We have seen companies where they might change their program because it's quite competitive. But generally, a captive is established at the outset because the company is so confident in its risk management framework that they know that the loss history is such that they want to capture those profits themselves.
Yes.
But yeah, I mean, we had when I kind of came back into the insurance world in kind of 2001, having spent a few years doing banking. We had some hardening markets around that time, and then they softened for many years, but it didn't impact the captives that were being managed at the time. I mean, it just continued and proved to be a useful strategic tool to the client entity and risk manager.
Yeah. Yeah, this is something we often have questions about, in the immediate aftermath of COVID when the market was a bit harder.
Yeah.
We had that question. Now that it's softening, we've had that question. And, our view always at Ermic is, or what we often hear said is, it's not a decision you make based on a hard or soft market. As you say, it's based on your risk management, your confidence in your risk management framework, and also your long-term risk financing needs, because you don't simply go from deciding one year to having a captive to having it the next.
Yeah.
Due to, it's a long-term investment in time and energy.
Exactly. Yeah.
Yeah, very much. Well, we don't seem to have any more questions coming in. I mean, that was a very good collection. And I think, as I said before, that was a really great overview, very comprehensive, Justin. Just a word to everybody, the survey should be popping up any second now to allow you to provide some feedback. And you can also request a copy of the slides that Justin and SRS have provided on this survey. So if you click the button, we will get those sent through to you. And if anybody has any further questions for Justin or wants to be in touch with SRS, if you write to us here at Airmic, or myself, or my colleague Tam in our learning department, we will be happy to put you in touch. But it falls to me to say thank you very much, Justin, for today's presentation, for taking the time. And thank you and SRS for your continued support of Airmic. And we hope to have you back on the webinar series again very soon.
Okay, thanks everybody.
Thank you, and thank you to all of you for attending, and have a good rest of your day.
Thanks very much. Bye.
Bye-bye.